Baby questions for an investment banker.
I'm Dan Peter, and I've been in commercial banking for about 24 years, and I've been in my current position with a focus on real estate lending for about 7 years.
What are the basics for obtaining a loan?
Every investment real estate deal is different. There is no cookie cutter approach, really. When we're looking to make a loan decision, banks make decisions based on perceived risk. And so early on in their banking careers, every banker learns about the 3 C's of credit, and that's character, cash flow, and collateral. And so we look at the character of the people involved, the cash flow of not only the investment property, but also the person involved, their global cash flow, as well as the collateral.
What qualifies as collateral?
Collateral is something of value that the borrower is willing to pledge as security for a loan. Because we can make an unsecured note that has no collateral, and the borrower promises to repay that, but those aren't very popular because there's considerable risk involved if there's no collateral. Whereas bankers love real estate because it doesn't move. You know what the value, or at least the value is easy to determine. You compare that to if I take a bunch of cars as collateral, 10 cars, well, all of a sudden my collateral moves and you can't find it. So bankers love real estate.
What helps qualify a property for a loan?
When a banker is looking at a loan, everything is based on perceived risk. So the longer the history that's in place, the less the perceived risk. So you're going to look at history of the property in terms of how it's cash flowed. We're going to look at leases that are in place, that will give us a projected cash flow into the future. We're going to look at market, rents. Where is this property? And when you compare it to other similar properties in terms of rent and that type of thing. Are there going to be unforeseen maintenance issues in the future? It's really a common sense approach, I think. If you're looking at a piece of investment real estate, what are the different things you need to keep in mind as an investor? The banker's going to be looking at the same things.
What information should investors have when they apply for a loan?
On the residential lending side, or what everybody thinks of when they think of mortgage lending, there's a list of items that every borrower needs, and they have to bring this specific list to the bank. Commercial lending is a much different animal, and what you need, or what the borrower or investor needs when they come to the banker, it's really going to be dependent on the type of investment property that they're looking at. But kind of, some basics. The banker is going to want to see a personal financial statement that shows what that investor owns and what he owes. The banker is going to want to see 3 years of tax returns that detail the person's individual income and any ancillary business income. And then also, the banker is going to want to see as much information as possible about the collateral real estate. So if that's existing leases that are in place, the banker is going to want to see those signed leases. If it's historical cash flows, need to see those.
Can an investor get one loan for multiple properties?
Sure. We can certainly do one loan per property. That's an easy enough approach. But if an investor comes and he wants to if he's buying a package of properties, maybe 4 properties at once, we could conceivably make one loan that takes all 4 properties as collateral. Everyone would just need to agree on the front end what happens if one of those properties sells.
How is a business loan for an investment property different than regular mortgage?
Yeah, well, what we're talking about here is you've got two legal documents. A note, a promissory note, is a person's promise to repay money. A mortgage is the collateral document that the bank records at the county courthouse that gives evidence that the bank has a security interest in that note. So there's really no difference. You have a residential mortgage, your house is collateral. A business mortgage, the investment real estate is collateral. The reason there's a distinction between the two is because there's a bazillion people that need a residential mortgage, and so it's very standardized, the industry. Whereas the business side, you're typically dealing with business people, and so there's much more flexibility, much more creativity, because it's a business banker dealing with a business person. The business person's trying to make money on the deal, so it's a whole different approach. Versus a lot of people with getting a residential mortgage don't necessarily have business experience, so there's a tremendous amount of regulation that governs that industry to protect the consumer.
Any advice for new investors?
There's tremendous opportunities in real estate, especially in the greater Lafayette market. It's a tremendous, it has been for a long time, and it certainly looks like it will be for a long time. But every real estate investor needs to recognize that this is a long-term investment. This is not a get-rich-quick. In America, more millionaires have been created through real estate than anything else, but it doesn't happen overnight typically. Real estate is a long-term investment, and so any investor going into it needs to recognize that.
So you help me finance my properties, but who can help me manage them?
Let me think about that.
I've heard Sorola Property Management is the best in town.
Oh my gosh, yeah.
Thank you for watching this video. Please comment, rate, and subscribe. If you need help managing your property in the Lafayette or West Lafayette area, call 765-413-5885. Be sure to check out our other videos too. Have a great day.